Yes, it's still the case that, when things go awry, this one of the safest havens is
the U.S. dollar.
The U.S. dollar, yeah.
And that's sort of, there's a reflexivity there in terms of heightening the crisis because therefore you have the risk. And one of the risks, just to go back to your whole thing about EMs, one of the risks I would imagine is in terms of the balance sheet. That is, when we spoke before, you were telling me these corporates are not necessarily hedged. Yeah. So to the degree that they're unhedged, that means that their liabilities in a crisis situation would be increasing because the dollar value would be increasing, and their assets are stagnant or potentially decreasing. So the positives that you were talking about from the asset liability perspective become skewed in a negative direction.
That's a great point, and it's the interplay of two of those legs in a sense, right? The balance sheet with the dollar dynamics, right? And you can get an adverse outcome. It could go either way depending on the direction of the dollar, but if the dollar strengthens, right, you have this adverse balance sheet outcome. And what you've seen in EMs over the last 5-7 years is this advent of the currency trade, so to speak. So they'd borrow in dollars and denominate it in local currency, right? You can't carry it hedge; it's too costly, right? It's just too costly in domestic terms. So you saw a lot of that, 5 years ago, and there were a couple of disruptions, in the corporate space as a result of that. I think EMs have learned, the lesson, and so you've seen policymakers particularly clamping down on net open dollar positions and things like that. But you still see, from my work, significant open dollar positions, right? Meaning, if the dollar strengthens, you're going to get an adverse balance sheet impact, right? From that movement. So that's still prominent in EM, and that's part of the dollar dynamic equation, right? That's going to lead to a tightening in financial conditions and have adverse impacts on aggregate demand and growth conditions for EM. So that's a big issue for EM still. I mean, it's decreased, I'd say, over the last 10 years. But it's still an issue. It varies by jurisdiction, by sector, and things like that. But in aggregate, it's still a problem for EMs.
So now, obviously, when we're talking about the whole dollar dynamic, the Fed is the lender of last resort in U.S. dollars.
Yeah.
So they're on the hook to a certain degree.
They're on the hook.
If there's a liquidity crisis.
They're on the hook, yeah.
My question is, are there other central banks, let's say the Bank of China, People's Bank of China, that could potentially, through swap lines with the U.S. central bank, provide liquidity and therefore bail out, if you will, corporates out of a liquidity crisis without the Fed specifically provisioning liquidity to those central banks?
Yeah, it could be. We've seen that on a limited basis, right? Where there had been liquidity constraints or concerns in some countries. China would negotiate with other countries to provide some liquidity provision, not without conditions, of course, right? We could see more of that, right? China could tap their $3 trillion of dollar reserves, for example. I could see that as a possibility. Yeah, we got to think about the cascading impact of all this dollar issuance, right? So EM corporates, right, have issued a lot in the last 10 years, right? You think they're on the hook for that? No, absolutely not. Their governments are ultimately on the hook. It's a contingent liability for the governments, right? If corporates in their jurisdiction get into trouble, right, they're on the hook, right, by providing dollar liquidity through their, central bank FX reserves, for example, or other means, right, macroprudential provisions through the banking system, other mechanisms like that. It's the governments that are on the hook for that, right? And who's on the hook, for the governments? It's the Fed ultimately that's on the hook for that, right? It's the Fed that's going to have to provide that liquidity if and when we get into a situation where there are dollar access constraints, right? And that will happen. It's just a question of when and how that happens, right? It's hard to time that and foresee that exactly happening, but it will happen, and the Fed's going to be on the hook for that, ultimately.
But the preconditions for it's happening right now, in your view, are not present. When you were talking about the balance sheets earlier, you were largely positive.
Yeah, I don't see that as an imminent risk. Right? Famous last words. But, look, I've been, like I said, call it like I see it. And I've been, very prescient in a lot of these, disruptive outcomes that we've seen in markets. And I don't see it as an imminent threat or concern, partly because central banks, policymakers have kind of learned their lessons, so to speak, from the past in a way, and I think they're very much attuned to these, disruptions in money markets and in the funding markets, let's say, and I don't see any signs of stress there. I mean, of course, what happened in the repo markets is an example of it, but in a broad sense, I haven't seen signs of it. So I don't necessarily see that as an imminent risk, but it's out there.
Right.
It's certainly out there.
If you're ready to go beyond the interview, make sure you visit realvision.com, where you can try Real Vision Plus for 30 days for just $1. We'll see you next time right here on Real Vision.